Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Hello, everyone. Welcome to Accredited Investor Markets Radio. I am Christopher Cahill. In a few minutes, I'll be speaking with Philippe de Lapérouse of HighQuest Partners. This is a firm which specializes in agriculture as an asset class and agtech as an asset class worldwide. This is not Charlotte's Web. This is the most exciting and palpable area of investment, in my opinion, and might be interesting for you to stick around after my comments. And my first comment is about an interesting article, about an interesting lawsuit. Intel is being sued by one of its employees for how it has invested the employee and other employees' 401k funds. The problem? Intel invested those funds in hedge funds and private equity. Hedge funds and private equities, these have been the superstars of returns in the last generation. Well, not according to this lawsuit, reflecting recent experience where these two vehicles have become characterized as risky and high cost. The article is in www.pionline, or Pensions and Investments Online, dated 10/30/2015 by Megan Kilroy. Wow. Which makes me want to tell you about two webinars we recently produced on Financial Poise Webinars, which is affiliated with this program. One is called Nuts and Bolts of Investing in PE Funds, and the other, Nuts and Bolts of Investing in Hedge Funds. These are, the panelists on these webinars are specialists themselves, but these webinars are done in plain English, moderated by yours truly, with the intent of educating intelligent non-specialists about these things. We have attorneys who advise hedge funds and PE funds. We have investment advisors who advise individuals and institutions regarding investments in these vehicles. And we have a representative from an online portal which offers access to accredited investors and other smaller investors to the high minimum world, the high minimum investment world of hedge funds and PE funds. The affiliations of our panelists include Schulte, Roth, and Zabel, Shepard, Mullen, Richter, and Hampton, Sugar, Felsenthal, Grace, and Hammer, Coral Gables Asset Management, and Dark Matter. I urge you to have a listen. Go to www.financialpoisewebinars.com or the Financial Poise portal website. Okay, in Collections and Credit Risk on November 3, 2015, there was a piece, I just want to advert to it, called Tech Giants Join DC Fray to Battle Bank Calls for Regulation. All right, that's an overloaded headline. Basically, we talked on this program about how banks have been trying to employ the powers of federal regulation and perhaps state regulation to improve their competitive position with regard to disruptors in the P2P financing world, the peer-to-peer financing world. Banks do not like that they're losing lending presence to these innovative entities and are calling for regulation. We've talked about this in the past. Well, Google, Amazon, Apple, PayPal, and Intuit, this is 1927 Yankees of a corporate lineup, have formed a lobbying and advocacy group dedicated to financial issues, specifically to battle the banks doing what I was just describing. The initiative is called Financial Innovation Now. It's a lobbying group, and it's touted as a defensive measure against banking groups. Now, these are 5 of the most powerful corporations in the world, and them against the large banks is truly King Kong versus Godzilla, and query whether we really should regard Google, Amazon, Apple, PayPal, and Intuit as proxies for much, much smaller P2P disruptors. I guess we'll find out. But let's turn to China. And I want to turn to China for a couple of reasons. One, there's some interesting things to say about China. And secondly, we'll have somebody on this program for at least 2 programs very shortly. His name is Ed Lehman. He is the founder of Lehman and Liu, the largest foreign-run law firm in China. He's been there for 28 years, and he will be here to talk about things Chinese. But first, before we get to him in a few weeks, the American Civil Liberties Union has warned about, well, I'll just give you the title of their warning. China's nightmarish citizen scores are a warning for Americans. Citizen scores. Well, the ACLU warns that Alibaba and Tencent, which run all the social networks in China and have access to a vast network and vast amount of data about people's social ties and activities and what they say, are going to work with the Chinese government. The Chinese government is going to create citizenship scores based upon such data, and which will reward citizens for saying and thinking and doing the right things, and penalize them for associating with those who do not say and do not do the right things. And this can be found on the ACLU website, www.aclu.org. I've already given you the title. The author was Jay Stanley. Well, that wasn't the final word on this. Tech in Asia, an online publication from Singapore, on October 8, 2015, tried to issue a corrective to the ACLU. It's entitled, China's Citizen Scores Credit System is not as Orwellian as the ACLU thinks, ... yet. And Tech in Asia points out that Alibaba has something called the Sesame Credit Scoring System. Tencent has its own credit scoring system. And the government of China will create its own scoring system, which will be mandatory in 2020. They're not the same things. They draw from different sources, at least presumably. The government's 2020 credit scoring system is explained in a publication that Tech in Asia read. And here's what Tech in Asia says. It's clear from the text that Chinese authorities don't want a credit system that's completely focused on finances. Rather, they paint the new system as a way of rewarding, quote, sincerity, end quote, and punishing insincerity throughout society. Close of the piece is, for the moment, though, take whatever you read with a grain of salt. China has no mandatory citizen score system yet. The details popping up all over the web about that system appear to be taken from Alibaba and Tencent's wholly separate, definitely not mandatory credit scoring systems. A lot of these details also appear to be exaggerated. All right, a few words about Tencent. Tencent is a massive company. It is China's biggest social networks and online games company. And the Wall Street Journal of November 7th and 8th writes about a pact signed between Tencent and Hollywood Studios, 2 Hollywood studios, to distribute online in China the entire James Bond franchise and coming movies such as the next Star Trek. Now, China is the world's largest internet market with about 650 million users. Also the world's second largest movie market by box office. And box office is key in China because there's no legal DVD sales in China due to piracy. Box office receipts currently account for virtually all movie revenue in China. This is drawn from the article. And Tencent will have the whip hand, at least with regard to the products of those 2 studios. So Tencent's a big deal in China. Now I'm going to do something very odd. Having drawn on the ACLU, I'm going to draw on the Weekly Standard in the same segment. The Weekly Standard is known as a conservative political magazine. Well, the Weekly Standard has reported on the apparent citizenship scores and has reported in the past on Yahoo, which owns part of Alibaba. Now, it's Alibaba and Tencent, remember, who will be working with or in conjunction with the Chinese government in assembling information. I'll just quote from the October 19th, 2015 Weekly Standard. Yahoo was allowed to purchase a big chunk of Alibaba way back in 2006. It did so less than a year after it, at the request of the Chinese government, gave up the identity of a democracy activist who was anonymously using a Yahoo email address. I was paraphrasing just then, but now I am quoting. Journalist Shi Tao, as a result, was sentenced to 10 years in prison for leaking Chinese propaganda department directives showing that Beijing was suppressing attempts to commemorate the 15th anniversary of the Tiananmen Square massacre. So, Yahoo got approval to purchase extremely lucrative pre-IPO stake in Alibaba just after it cooperated with the Chinese authorities oppressing Shi Tao. I guess you can make of that what you wish. I'm just reporting. So let's turn to Philippe de Lapérouse and agriculture and agtech. We have with us today Philippe de Lapérouse. Mr. de Lapérouse has more than 30 years of senior level experience working with global companies in the agro-industrial and value-added food chain, including Ralston Purina and Bunge, an investment banker at the beginning of his career. As managing director of HighQuest Partners, he has advised major strategic and financial investors operating and investing globally across the food, biotech, and bioenergy value chains with respect to agriculture. And this includes resource allocation, new business opportunities, and developing investment strategies. Among his many activities, Mr. de Lapérouse serves on the advisory committee of the Ag Innovation Showcase at the Danforth Plant Science Center in St. Louis, Missouri, and is the author of the report entitled Private Financial Sector Investment in Farmland and Agricultural Infrastructure. This is dated 2010 and was commissioned by the OECD to provide insights on this emerging asset class and the impact that private sector investment is having on the regions in which it occurs. Thank you for joining with us today to talk about agriculture, Philippe.
I look forward to it. Thanks for the invitation.
You're welcome. So what is HighQuest Group and how are you involved in the agricultural and financial sectors?
HighQuest Group is an events consulting and media company that is focused on serving clients across operating or investing across the global food and agricultural value chain. Specifically, in terms of events, we organize and I chair a series of events where we bring in institutional investors to meet with fund asset managers specialized in the space, discuss opportunities for investing, and we do that in food and agriculture. And we organize those annually in New York, London, Dubai, and Singapore. And we also organize industry conferences for the oilseed and grain industry trade in the U.S. and Europe. On the consulting side, we advise clients, both strategic, that is corporations, trade organizations, governmental organizations, on issues related to strategy or different opportunities for resource allocation in the sector. And we also advise institutional investors that are increasingly allocating capital to investments in the food and agricultural sector on a global basis. And then in terms of media, we provide resources, information, data for clients that are also following trends in the industry.
So I guess to summarize, one might say that you cause information flow for two reasons. One, to help others with their allocation of capital, and secondly, to advise yourself on the allocation of resources and capital in private business and industry.
That's correct. I mean, some of the information we collect, we use on behalf of our clients, and we, because of our working in these three different pillars, it puts us in a good position to understand what's the trends that are occurring in the industry and what the potential impact is for clients, not only that we're traditionally considered agricultural companies or in agribusiness, but also increasingly we see a lot of other companies and investors that have realized that they have some exposure to the sector. in terms of feedstocks and that sort of thing. So it's a much wider group of.
Let's talk about them. Who are they? Who are those who perhaps are perceiving a greater connection to the fortunes of agriculture?
Well, sure. Well, I mean, I think a lot of companies, if you look at on the corporate side, a lot of companies, there are a number of companies that have been sourcing ingredients derived from the agricultural value chain that never really saw themselves as having exposure in the industry, whether it's in industrial applications or substitutes for petroleum-derived ingredients, such as energy project, ethanol, let's say, or biodiesel. And so, whereas in the past, those companies never really thought of themselves as having exposure to agriculture, now that's no longer the case for them. And so they need to get up to speed fairly quickly in terms of what's transpiring, the trends in the industry. We also see, starting particularly in 2008 with the institution of the renewable fuel standards by the federal government here in the U.S., as well as similar types of standards that were established in other major countries, that there was a strong correlation between the energy markets and commodities, not only because energy was used to produce those commodities, and that's always been the case for a long time, but because some of the output from the commodity production was being used to replace fossil fuels. So we've seen a wide range of new interested parties trying to understand what their exposure is. And we also see governments being very concerned because of food security issues related to making sure that they're not caught out of stock, to make sure, to supply the needs of their growing urbanized populations, particularly in Asia, but also in the Middle East and North Africa.
So let's go back to what you were saying about ethanol and biodiesel. It's something I've simply never thought of. I mean, I'm aware that grain prices and so forth have gone down, but perhaps not nearly as dramatically as oil prices and natural gas prices.
Right.
And of course, there's the penetration of the market by governmental mandates, political mandates. But have we seen any ethanol and biodiesel being replaced by gasoline or natural gas?
No, but it's had an impact on the price level. So that's had an impact on margins, but then has an impact and results in the decisions that companies will make as to whether or not they're going to operate at capacity or reduce throughput, simply because the margins generated doesn't justify that. So that's where the connection is.
Well, when you're looking at what we used to call the third world, which you were just referring to as places with vastly enhanced urbanization over the last period, and some issues about food security. Is there a movement there, or I should say, did the plunge in gasoline and natural gas prices worldwide affect their strategies with regard to supply chains and logistics?
Well, I think what it does is that it makes, and that's been reflected in the drop in commodity price levels that we've seen in soft commodities, that is agricultural commodities, which have followed and on the step of hard commodities and energy. So we've seen, a similar drop in soft commodities. The question is whether or not that drop will be sustained over the long term. There has been an overhang in the market in terms of supplies, which has resulted in less need, less competition for those commodities, which has resulted in lower prices. The issue is, though, that those inventories don't last forever, and with climate change, and there's some trends, some rather unnerving trends that we see in terms of climate change. And I'm not talking just about cataclysmic type of events, but also nighttime temperatures rising in major origination zones in North and South America, and also pest resistance, both weeds as well as insects, causes one to have some concerns about the future. But, what we're talking about is kind of a long-term trend, not one necessarily that's going to see any impact on prices within the near term, let's say within the next 12 months. But, of course, if we're going to assure sufficient supplies of both food as well as of small commodities for the longer term, that requires investment in infrastructure, transportation, and logistics, which all presumes that one is going to have to be marshaling capital ahead of time to get ahead of the curve. Otherwise, we'll see major disruptions going forward.
All right. Do you see then the logistical sector that you just described as a reasonable investment play for investors who do not need to liquefy their investment in the near term?
Yes, I do. I think actually it's one of the more exciting areas. We have been somewhat surprised that, and we do see initiatives being undertaken to pursue opportunities in that area. I've been surprised that it's taken. We started this whole phenomenon of looking at institutional investment in agriculture started back in the 2004, 2005, but really picked up steam following the economic crisis that developed in late 2000, the fall of 2008. And I've been surprised that it's taken until now, so roughly 7 years, for really to pick up steam, because I do think that for investors investing in infrastructure, which is basically investing in a bottleneck situation, where you basically or your asset is working and should be working fairly consistently if it's well positioned and geographically and the site's well suited for handling large scale type of commodities. It's a very interesting business model. And of course, I talk about large scale. I think there are also opportunities in smaller scale type opportunities, entrepreneurial opportunities that we see taking off here in the U.S. in terms of local sourcing of both locally grown crops, fruits, and vegetables. I'm talking now not about large-scale monoculture row crops, but I think there's lots of opportunities in this area as well for entrepreneurs.
Well, speaking of which, had other guests on in the past who have talked about agtech and its astounding ways of changing the landscape of agriculture in the U.S. and I assume other highly developed countries. And agtech is, I take it, distinct both from ag and from the logistics we were just talking about. So how should investors think about agtech, and should they think about it as distinct from logistics and agriculture itself?
Yeah, right. No, that's a good question. So I think maybe just stepping back slightly, I think it's important to realize that just as there are different types of investment opportunities that could attract capital from investors, there is a whole ecosystem of investors out there that needs to be understood, and not all investors are seeking the same type of risk-return profiles in some of the investment projects that they're reviewing. So an investor that is, let's say, trying to match liabilities of a pension fund, and you're talking about 25, 30 years, is looking for a very stable type of return over a long period of time, and does not have to be generating excess returns, or doesn't need to be taking excess risk to generate those returns. So that's a different class of investor that would be looking to invest in early stage VC or venture capital type investments in early stage agtech that may be looking for 25% return, 20% return on a portfolio. And so they're looking for something, or maybe a little bit less than that, but they're looking for returns in excess of that on each of their portfolio, their investee companies. And they're looking to turn those around in 3 to 5 years in terms of some sort of a liquidity event. So what we see in terms of the investor class looking at opportunities in agriculture is as varied, if you will, in terms of different segments as are the vehicles that they have an opportunity to invest in.
Well, let's complicate the picture a little more. I mean, we could divide the world up, just for the purposes of this question, between places like Russia, Brazil, and Argentina, sure, which are struggling, to put it mildly, and the U.S., Canada, and Australia, which are comparatively doing well. How do you think differently of agricultural investment opportunities in the struggling versus the non-struggling worlds?
Well, I mean, what you referred to major origin regions, I mean, major regions that are producing and exporting and have excellent supplies because of their production, which they then trade into the global markets or regional markets, yes, such as Russia with wheat going into out of the Black Sea into the Mediterranean to supply the Mideast and North Africa. So, whereas the U.S. is the largest exporter of corn in the world. Brazil and Argentina combined now vie with the U.S. as a major source of soybeans. So each one has its role. I mean, as investors look at where to invest in those markets, the U.S. would be perceived as a lower risk opportunity, and which then presumes a lower return because one's taking a lower risk on allocating that capital into the marketplace. Whereas someone looking to invest in Eastern Europe and the land back, let's say in Russia, is going to be expecting a much higher return because of the higher risk they're taking. Same would be true of Ukraine, which is a little bit more complicated because if you look at real assets, which is farmland and infrastructure, foreign investors are not allowed to own farmland, so they do it as a kind of a private equity deal. They're basically leasing land over a period of 30 years with options to renew. So each region outside of the U.S. and Canada and Western Europe, which is not really attracting all that much capital for investing in land for a number of reasons. Most countries, well, I should say in Australia, with the exception of Canada, the U.S. and Australia, and Brazil, though there's a moratorium on large-scale foreign investment in Brazil, a lot of these countries do not provide or do not enable investors to have free title to the land. So that doesn't mean that investment isn't going into those areas, let's say on production agriculture, but it's being done in a way that's a bit different and a different risk profile.
That's the general picture, and I think it's highly useful. But Russia, of course, it's the fact that Russia is facing sanctions and Argentina is, seemingly, well, I don't want to say cratering, but it's undergoing great stress.
Well, I guess we'll see in 2 weeks, right, with the elections, the runoff that happens. I just happened to have lunch with 4 Argentines from Buenos Aires who were all going back to make sure that they vote for a change in that country. There seems to be a certain amount of optimism that change may be coming. So Argentina, we could see a turnaround in Argentina if that position pulls off a victory.
It should be interesting indeed. Well, we've just touched upon things that all sound extremely interesting to me, between investing in logistics in emerging countries, ag tech as a form of VC investment, as well as investing in the actual commodities themselves. Do you believe that for, let's say, accredited investors, not institutional investors, but people who have money for one reason or another and are investing, do you think agriculture is overlooked by them, or for that matter, by the institutions?
Well, yes. Yes, we have been able to demonstrate that. We did some research about 3 or 4 years ago where if you compare the investable universe of farmland compared to the institutional ownership of investable universe of farmland compared to the institutional ownership of the investable in a universe of timber, farmland is way far below, and I'd have to look it up as we speak, but it very much is there's a big opportunity if you just quadrupled or multiplied by 5 current institutional investment in farmland. It would be a very large, sizable amount of capital that would go into the sector, which really would only cause a minor dent. So the difference between farmland and timber is that timber is highly consolidated, and the ownership is not fragmented the way farmland is fragmented. So farmland presents a different challenge for investors to be able to invest in. That's why you've seen it take a while for these new REITs to be launched into the marketplace, which now exist. Retail investors do have the opportunity to invest in farmland in the U.S. and Canada through various REITs that have been launched into the marketplace. So I think that both for institutional investors and for accredited investors as well as a class, yes, that investment in real assets, let's say, or in agriculture more broadly, has probably been underweighted. And I think, we've been able to show, particularly as related to farmland, that having a certain allocation into farmland improves the overall return on a portfolio.
There was a large USA Today article some time ago about the increased level of foreign investors, especially from China, and the prospect of even larger amounts of such investment coming to places like the United States. But the emphasis of that article was on real property in urban centers, especially the more attractive urban centers like New York, Miami, San Francisco, right, and so
Manhattan has changed a little bit because of that. Yeah.
Yeah. Do you see a similar movement of such capital into, since we're talking about farmland, or is that something that's likely to burgeon in the future?
Well, I guess a little history first. There always has been a foreign investment in U.S. farmland going back to the 19th century. I mean, for instance, the railroads, which were really the vector for developing real estate and farmland out through the central corn states, Corn Belt, and out to the prairies, were financed by British investment largely, and so there have been family offices, individual, family groups that have long from Western Europe, the Netherlands, Germany, Switzerland, and other countries that have long had investments in farmland in the U.S. It's just not. It remains under the radar screen, if you will. They've rather discreet, and they've held the land for a long time, and they basically, they're not necessarily known per se as being foreign investments or foreign investors because they're the operators that they've engaged to manage their properties. They're typically local neighbors or farmers who lease the land on long-term leases. I don't see foreigners necessarily coming in en masse into the U.S. for a number of reasons. One, there's corporate farming laws in many of the major origination states in the U.S., and I think for political reasons it would raise hackles if all of a sudden you saw a rush of foreign investors to acquire land, particularly farmland, in the U.S.
Yeah. Very interesting.
But that's not to say that there aren't individual situations, but I don't know that it would necessarily become a major phenomenon. What's interesting is, we in the U.S. will take umbrage at the restrictions on foreign investment in other countries because it's a restraint of free trade or whatever, and yet I think sometimes we don't necessarily look at it the same way when the investment is coming into the U.S.
Oh, if you're old like some people, you would know about the spate of movies in the late 70s and early 80s, which were generated by fear of the Japanese buying up everything.
Well, Rockefeller Center, right? Yeah.
Exactly.
I don't know how old do you have to be to remember that?
Old and
yeah, right.
Well, let's finish with a focus on the accredited investor, who's heard a lot of things maybe already before listening to this program, and is interested in agriculture, or for that matter, aquaculture, and as we've already said, the non-food, non-commodity aspects like logistics, agtech, and so forth. All right, so how should they think about these different exposures, liquidity, non-liquidity, and diversification within the portfolio of a mere millionaire who is investing, who wants to invest in this?
Yeah. Well, I think, the easy way in has been, and I think you saw people jumping in. It's a little like day trading. You saw some investors getting involved in commodity index funds, which is, it's very easy to go in and out of those funds. And so I wouldn't necessarily, depending on what one's track record is and how closely one follows it, I wouldn't suggest or think that would be the optimal way for an accredited investor with $1 million to get exposure into agriculture. But of course, there are a number of ways of doing that do provide liquidity or a certain amount of liquidity, or there may be opportunities where you don't necessarily where you don't need the liquidity. But there's ways of investing. You can invest in public equities of some of the major companies involved in the sector. I mean, and I'm just throwing out names, not promoting any one particular company, but you have all the biotech seed companies such as Monsanto and DuPont, which has a large exposure with Pioneer Hybrid, Syngenta. Of course, the stocks on Syngenta, Monsanto moved around a lot when there was this past summer when there was negotiations over the possible takeover of Syngenta by Monsanto, or merger, I guess. John Deere, some of the chemical companies that are selling into the sector. There are other companies selling services, or by companies such as Bunge, which is the largest edible oilseed processor, or ADM, which is a competitor of theirs as well. So there are numerous opportunities with public equities to invest and get exposure in the sector. There, as I mentioned earlier, some of the newly issued REITs, real estate investment trusts set up for investment in farmland in the U.S. And there are other opportunities maybe to do less liquid investments in terms of investing in funds, regional funds that have been set up to acquire farmland and develop that farmland for different applications and purposes.
By the way, I should apologize to the good folks over at Bunge for mispronouncing the name of their company in my intro.
Well, yeah, I was going to mention that to you when you went through I did mention that.
There's so many companies to remember.
Yeah. But that particularly peeves them when they hear Bunge or,
Well, they don't give us much of a chance. Well, Philippe de Lapérouse, it has been a pleasure speaking with you, and thank you for calling us all the way from HighQuest Partners.
Thank you very much. Enjoyed it very much.
This has been Accredited Investor Markets Radio. Accredited Investor Markets Radio is produced by Stephanie Strait. Thank you all for listening. Let's do this again sometime soon.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.AIMkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.AIMkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.